The world is witnessing the silent erasure of $4 trillion. This isn't a normal dip, it's a total failure of the financial system you were told to trust. Right now, a math signal that predicted every major crash since 1960 is flashing red with 100% accuracy. While most people are losing their life savings, the elite are using this chaos to buy assets at prices we haven't seen in decades. In this video, I will reveal the exact data proving why the market is broken and show you the specific assets where the world's smartest money is moving right now. Before we start, what is the biggest financial threat to your family's future in 2026? Let me know your age and your main concern in the comments below. The carnage began quietly in early 2026. Within a matter of weeks, the U.S. stock market saw $4 trillion of perceived value simply vanish into the ether. To understand the gravity of that number, imagine the entire economic output of Germany, the fourth largest economy on Earth, being deleted from existence in less than a month. The average investor is waiting for a bounce, but they are waiting for a ghost. The reason for this massive liquidation is not psychological, it is chemical. It is a reaction to the sudden, violent return of the one force that the modern financial system is not built to survive: aggressive structural inflation. Most people view inflation as a mere inconvenience, a slight increase in the price of a gallon of milk or a tank of gas. That is the perspective of the victim. To the elite, inflation is a predatory force that reorders the hierarchy of wealth. When inflation sits at a comfortable 2%, the system functions as a predictable machine. But the moment it scales toward 4 or 5%, the fundamental laws of asset pricing are rewritten overnight. We are currently watching the rules of the game change while the players are still using the old manual. The catalyst for this shift is a geopolitical explosion. Conflict in the Middle East has sent oil prices on a 40% vertical climb. While politicians and media outlets focus on the surface-level drama of ceasefires and diplomatic negotiations, the visionaries are looking at the input costs. Oil is not a commodity. It is the blood of the global economy. It is the hidden cost embedded in every shipping container, every factory line, and every kilowatt of electricity. Even if a ceasefire is signed tomorrow, the structural damage is already done. The inflationary data for March 2026 is a ticking time bomb, and when it is released in April, it will reveal a headline inflation rate surging toward 4%. This is a reality the market has not yet priced in because the market is still clinging to the hope of a soft landing that no longer exists. This brings us to the single most important metric in your financial life: the real earnings yield. This is the indicator that has flashed red before every single market catastrophe in modern history. To understand this, we must look past the surface noise of stock prices and look at the actual yield of the S&P 500. As of 2026, the S&P 500 is priced at roughly $6,600 per share. The collective earnings of those companies are approximately $234 per share. If you do the math, that is a nominal earnings yield of 3.5%. For the last few years, when inflation was low, a 3.5% yield was acceptable. If inflation is at 2.5%, you are earning a real inflation-adjusted return of 1%. You are moving forward. But the moment inflation hits 4%, the math turns hostile. Your real earnings yield drops to negative 0.5%. At that exact moment, the S&P 500 becomes a liability. You are literally paying for the privilege of losing purchasing power. This is the point where the average investor enters the kill zone. History shows us that a negative real earnings yield is the ultimate signal of an impending bear market. In 1987, the yield went negative, and the market suffered its largest single-day crash in history. In 1999, the yield went negative, and the Nasdaq proceeded to lose nearly 80% of its value. In 2007, the yield went negative, and the global financial system nearly disintegrated. There are no exceptions to this rule. When the cost of living rises faster than the earnings of the companies you own, the only logical outcome is a massive repricing of those companies. Now pause and ask yourself a difficult question. Are you holding assets because you have a strategy, or are you holding them because you are afraid to admit that the world has changed? Most people will cling to their sinking portfolios because their identity is tied to being an investor. The visionaries, however, know that wealth is never destroyed, it is only transferred. If you recognize that you have been following a script written for a different era, comment the word awake below. The system relies on your belief that the Shiller PE ratio and other high valuation metrics can stay elevated forever. For years, the market stayed expensive because the discount rate on future cash flows was low, but rising inflation is the ultimate gravity. It forces investors to demand a higher premium for the risk of owning stocks. When high valuations meet rising inflation, the result is a violent correction that wipes out the unprepared. But what if the consensus is wrong? What if oil drops below $80 a barrel and the inflation spike is just a temporary glitch? This is the steelman argument that the average investor uses to justify their inaction, but it ignores the structural reality of the commodity supercycle. We are not just dealing with a war, we are dealing with a decade of systemic underinvestment in the physical world. For the last 10 years, capital has flowed into software and digital abstractions while the infrastructure of the real world has been left to rot. Look at the data. Commodity-related ETFs currently represent only 3% of the total ETF market. In 2011, that number was 12%. This massive gap represents a decade of capital starvation in mining, energy, and infrastructure. We are now entering a period of forced catch-up. This is why the US dollar is weakening against gold. Gold is the canary in the coal mine, signaling that the era of cheap, easy growth fueled by paper currency is coming to an end. A weaker dollar means that every barrel of oil and every ton of copper becomes more expensive, regardless of what the Fed says or what happens in a ceasefire. This is where the great rotation begins. While the mass market is being liquidated, a specific group of assets is sitting at a generational entry point. The first of these is energy infrastructure. In the 1990s, we built the internet. In 2026, we are building the physical backbone for artificial intelligence. The data centers required to power the AI revolution are energy vampires. They consume electricity at a rate that is projected to double by 2030. This creates an unprecedented demand for the physical networks that move and store energy. Unlike speculative tech stocks, energy infrastructure companies own the pipes, the grids, and the terminals. They are the toll booths of the digital age, and their revenues are tied to the volume of energy moving through the system. They are positioned at the intersection of a commodity boom and an AI infrastructure build-out. The second pillar of this rotation is nuclear power. For decades, nuclear was the forgotten energy source, but the titans of Silicon Valley have recently realized a cold truth. You cannot power a global AI intelligence with wind and solar alone. You need high-density, always-on baseline power. This is why companies like Microsoft and Amazon are now pivoting toward nuclear energy. We are in the early stages of a nuclear renaissance. From uranium mining to the construction of small modular reactors, the entire supply chain is currently mispriced. The runway for growth here is measured in decades, not quarters. The third and perhaps most overlooked opportunity is in base metals, specifically copper. Copper is the metal of the future. Every electric vehicle, every solar panel, and every grid expansion project requires massive amounts of copper. But here's the data point that should stop you in your tracks. When you measure the price of copper relative to the price of gold, copper is currently at its lowest relative price in recorded history. This is a statistical anomaly that cannot last. Historically, commodities are mean reverting. If copper were to simply return to its historical average relative to gold, the price increase would be staggering. The companies that control the mines are the new oil barons of the 21st century. Their costs are fixed, meaning that every dollar increase in the price of copper flows directly to their bottom line as pure profit. Think about the psychological weight of what you are currently holding in your portfolio. Does it represent a hope that the old world will return, or is it a calculated bet on the world as it actually exists today? Many of us have been taught to play it safe, to follow the crowd, and to trust the institutions. But that trust is often a cage that keeps us from seeing the exit. What is the one financial fear you have kept hidden, even from yourself as you watch the headlines? Share your thoughts in the comments. This is a space for those who are ready to face the truth. To bring this full circle, the U.S. stock market is standing at a precipice. A $4 trillion loss is not the end, it is the warning shot. The signal that has accurately predicted every bear market for 60 years is flashing red once again. The real earnings yield is collapsing, and the era of low inflation, high valuation growth is over. But for the builders, for the visionaries, and for those who understand the mechanics of the great rotation, this is the most exciting time to be an investor in a generation. The assets that will dominate the next decade, nuclear power, copper, and energy infrastructure, are currently being ignored by the masses who are too busy mourning their dying tech portfolios. The strategy of the elite is simple. They identify where the capital must flow by necessity, not by hype. Capital must flow toward energy. It must flow toward the physical materials that build the future, and it must flow away from the overvalued ghosts of the last decade. This is not a matter of opinion, it is a matter of mathematical inevitability. The people who look back at 2026 as the year they achieved financial freedom will be the ones who saw the signal, ignored the noise, and positioned themselves before the rest of the world caught up. Success in this environment requires a stoic rejection of the consensus. It requires you to look at a $4 trillion market crash and see not a tragedy, but a massive liquidation sale of the assets that actually matter. The historical precedents are clear. The data is unshakable. The only question that remains is whether you will have the courage to act on what you now know. As we conclude, I want to offer a final perspective for those who have stayed until the end. Most investors believe that the greatest risk is a market crash. They are wrong. The greatest risk is not a crash. It is the slow, silent erosion of your life's work by a system that no longer values your currency. A market crash is a sudden event, but the loss of purchasing power is a terminal disease. While the average person is worried about their stock ticker, the elite are worried about their purchasing power. They don't want more dollars, they want more of the things that dollars can no longer buy easily. This is the secret filter through which every high net worth individual views the world. If you understand that wealth is about the control of resources, not the accumulation of paper, you are already ahead of 99% of the population. For those of you who have internalized the gravity of this moment and are ready to join the ranks of the builders, I have a request. Comment the secret password "I am awake" below. This is how we identify the members of this community who are truly paying attention and who are ready to navigate the coming storm with precision and authority. Building wealth in a time of chaos is not about luck. It is about having the right map. We are here to provide that map. If you found value in this analysis, share it with one person who needs to hear the truth, and make sure you are subscribed to the channel. We don't offer financial advice, we offer financial sovereignty. We provide the insights that the mainstream media is too afraid or too ignorant to cover. Your journey to the top 1% starts with a single decision to see the world as it is, not as you wish it to be. The clock is ticking on the current financial system. The signals are clear. The opportunity is real. Now it is time for you to take the next step. Click on the video appearing on your screen right now to deepen your understanding of the Great Rotation and learn how to protect your legacy in the years to come. I will see you in the next one.